The person quietly living off their dividends is someone you would never pick out of a crowd. They are not the loudest account in your feed, the one promising you $5,000 a month in passive income by next spring. They drive something sensible. They live in a house smaller than they could afford. And once a month, money lands in their account that they did not work for. A small cut of the rent and the sales and the profits from companies they own a slice of. And their stomach does not drop when they check the balance. That calm is not luck. It is the entire point. Real dividend income in 2026 does not announce itself. It gets quiet, it gets comfortable, and from the outside it looks almost unbearably boring. Today you will see why that boredom is the tell, and why the loud, exciting version of dividend investing is the one that quietly wipes people out. Let me start with the idea that changes everything once you actually absorb it. Real dividend income is invisible. What you see online is never the income. It is the performance of the income, the screenshot of a huge yield, the thumbnail screaming about someone who lives on dividends on a beach, the account bragging about a 12% payout. All of that is noise pointed outward. You are looking at a claim, not a bank statement. And the loudest claims almost always come from the most fragile positions. The quiet person, the one whose dividend income you would never guess exists, is usually the one who actually built something that lasts. Here is what most beginners get wrong in their very first month. And I want to say it clearly because I watch it happen constantly. They find a stock paying 8, 9, 10% a year, and they think they found free money. They think a big yield means a strong company. It almost never does. Here is what is actually happening most of the time. The stock price fell hard because something went wrong with the business. And when the price falls but the company has not officially cut the dividend yet, the yield on paper looks enormous. A stock that paid $2 a year when it traded at $40 showed a 5% yield. That same $2 dividend, once the price collapses to $20, now shows a 10% yield. The number got bigger, but nothing good happened. The company is still in trouble. And within a few quarters, that dividend gets cut, the price falls further, and the person who chased the yield gets hit twice: smaller income and a shrunken investment. That is not a rare edge case. That is one of the most common ways beginners lose money in this space, and the flashy yield is the bait. So, real dividend income has to start with a boring admission, and it is the opposite of what the exciting accounts tell you. A safe, quality dividend usually looks unimpressive. A company that has quietly raised its payout for more than 50 years straight, through recessions, through crashes, through every crisis you can name, is often sitting at a yield of just 3 or 4%. It will never trend. It will never make an exciting thumbnail. And it is one of the most reliable income machines you can own. The boring yield is boring on purpose. That is the feature, not the flaw. This is exactly the kind of unglamorous, real math breakdown of dividend income I put out here every few days. The starting numbers, the honest timelines, and the traps nobody warns you about. Subscribe so the next one shows up in your feed before you go looking for it. To understand why boring wins, you have to understand the engine underneath it. And the engine is almost hypnotically dull to watch in real time. It is reinvestment. When a dividend lands in your account, instead of spending it, you use it to buy a few more shares. Those new shares pay their own dividends, which buy a few more shares, which pay more dividends. Slowly at first, so slowly it feels pointless, and then in a way that genuinely surprises the people patient enough to still be watching. It does not require a genius pick. It requires time and the discipline to not interrupt the process. And there is a second boring force stacked on top of it that almost nobody talks about. It is called yield on cost. Picture a company paying you a modest 3% today. That sounds small. But a quality dividend grower raises its payment year after year, while the price you originally paid stays frozen in the past forever. 10, 20, 30 years later, that same position can be paying you 8, 10, even 12% a year, measured against what you actually paid for it. The yield did not spike. The dividend simply kept climbing while your entry price never moved. The exciting investor chasing a 10% yield today often has less income in a decade than the boring investor who bought a 3% grower and left it completely alone. That is the whole game in one sentence, and it is invisible from the outside because it happens quietly over years in an account nobody sees. Now, let me be completely straight with you about the part most creators skip, because this is where the boring truth gets uncomfortable. If you put $10,000 into a well-built, quality dividend portfolio yielding around 4%, you are going to collect somewhere around $33 to $37 a month. That is a phone bill. That is a streaming subscription and a tank of gas. If you came here expecting a life-changing number in month one, that is not it, and I am not going to pretend otherwise. But here is what that number actually is. It is not the harvest. It is the seed. $37 a month, reinvested, buying more shares, which pay more dividends, which buy more shares, while the companies underneath keep raising their payouts on their own. The people who walk away in disgust at $37 a month never find out what it becomes. The people who treat it as the first line of a very long book are the ones showing their friends a number that looks like a typo 15 years later. The seed is boring. The tree is not. Here is something that genuinely trips people up, and it is the clearest example of how invisible real dividend income is. A quality dividend portfolio usually yields less than the market average. Your first instinct is that lower must mean worse. It does not, and here is exactly why. That market average is dragged up by a giant pile of high-yield stocks that are either about to cut their dividends, have already collapsed in price, or are built in ways that cannot last. The average is fat with the exact traps we just talked about. So when your portfolio yields less than average, it very often means you passed on the junk. It means you own income that has a real reason to exist and a real reason to keep growing. Lower yield on purpose is not behind. It is ahead. It just does not feel that way until the flashy dividends everyone bragged about 2 years ago start getting cut, and yours quietly gets raised for the 12th year in a row. Let me show you what this looks like in two people because it plays out constantly. Picture Marcus. He chases yield. Every position in his portfolio pays 8 or 9%, and on paper his income looks incredible. He posts about it. He looks like he is winning. But his holdings are fragile, stretched, one bad quarter away from a cut, and over the next few years, one by one, those dividends get slashed and his income quietly shrinks while he goes looking for the next big yield. Now picture Daniel. His portfolio is almost embarrassingly boring, full of companies that raise their dividends 3 or 4% a year and nothing more. Nobody would ever guess he is building anything. But every year his income rises on its own, his reinvestment buys more shares, and a decade in, his boring machine is quietly paying him more than Marcus ever collected at his peak. And it is still growing. Marcus looked rich and was fragile. Daniel looked like nothing was happening and was free. Only one of them ever has to worry, and it is not the one you would guess from the outside. For the clearest living proof of this, look at one of the greatest investors who ever lived. Warren Buffett spent decades buying boring, dividend-paying companies and holding them essentially forever. His original stake in Coca-Cola cost him roughly $1.25 billion, built up more than 30 years ago. He never sold. And today, that single boring position pays Berkshire around $700 million a year just in dividends. Sit with that. Every single year, that one investment pays back around 60% of what he originally spent on it, on yield on cost alone, without him ever lifting a finger or selling a share. There was no clever trade. There was no perfect timing. There was a quality dividend grower, bought once, and left completely alone for a lifetime. That is the entire philosophy, and it is invisible right up until the moment the numbers become absurd. So why does almost nobody do this? Why does the boring truth stay hidden? Because an entire industry makes its money keeping you excited. The flashy high yield, the hot new fund, the account promising you can live off dividends in 3 years. All of it is engineered to feel like opportunity because excitement is what sells. Nobody builds a marketing budget around patience. Nobody gets rich telling you to buy a boring dividend grower and then do absolutely nothing for 20 years. The strategy that actually works generates no headlines, so it gets drowned out by the strategies that mostly do not. You are not behind because you missed a secret. You are behind because the truth was too boring to trend. And I have to be honest with you about the risk because pretending it does not exist would make me exactly like the loud accounts. Dividends are not guaranteed. Any company can cut its payout, and some will. That is precisely why the boring approach matters so much. Why you spread your income across many quality payers. Why you check that the dividend is actually covered by earnings and cash before you buy. And why you never reach for a yield just because the number is big. The whole point of boring is that it survives the bad years. That is not a weakness of the strategy. It is the strategy. So let us be clear about what real dividend income actually is underneath all the noise. It is not a screenshot. It is not a number you show other people. It is money that arrives whether you worked that month or not quietly on a schedule, from things you bought once and were patient enough to keep. It is the slow disappearance of the feeling that you have to trade every hour of your life for every dollar you spend. A truly wealthy dividend life is almost astonishingly quiet, because that kind of peace does not need an audience. The reason it looks boring from the outside is that all the real action is invisible. It is happening in accounts nobody sees, in reinvested payments nobody claps for, and in a person who finally gets to stop performing and just live. Here is the freeing part. If real dividend income is boring, then it is also learnable, repeatable, and available to completely ordinary people on ordinary incomes. You do not need a viral pick or a genius idea. You buy quality companies that pay you to own them, you reinvest every dividend, you refuse to chase the flashy yields that blow people up, and then you do the single hardest thing in all of investing, which is to wait while it compounds. That is not a secret reserved for the lucky. It is a boring routine you can start this month. Let your portfolio look a little boring on the surface while the real income builds quietly underneath, and give it enough time, and one day you will be the calm person someone else looks at and never suspects. If you want to see exactly how this boring machine gets built from the very beginning, the next video breaks down what happens when you start with almost nothing, just a small amount every single week, and let time do the heavy lifting. It is the logical next step, and it reframes what starting small actually means when you have patience on your side. It is on your screen now. And before you go, I want to hear from you, because these conversations get honest in the comments. What is the monthly dividend income number that would actually change how you feel about your job? Not quit forever money, just the number that would give you breathing room. Drop it below and tell me one thing in this video that changed how you look at that flashy high yield you almost bought.